Hi everyone. So I'd like to start in this section with going into more detail about the financial glossary or terms of how you can own a part of a company. So I don't know about you, but and I'm talking mainly to my female students over there. Even though I'm very busy, I'm very educated, I work very hard. Usually my husband is the one that kind of deals with all our financial investments. Okay, this was the case until a few months ago. He deals with all the retirement issues, he deals with all the stocks and everything. He just informs me when he does something and he goes ahead and does it. Because I trust him and he's much better than me at these things. He's a CEO of many companies. So even though I understand the terminology, I didn't always understand all the nitty-gritty of it. So when I started on this path of cryptocurrencies, I was actually very excited because it kind of got me into the details of investments. And now I'm able to actively participate in our investment as well when we're investing in stocks and things like that, not only in the cryptocurrencies. So I thought it would be a good place to start just to give you the foundation. So I'm going to explain to you in this video what is an IPO. So IPO is initial public offering. So when you get a company, usually it's a private company. It's owned by certain shareholders, a small amount of shareholders, which is either the founders of the company and their families, or it's the investors, whether it's venture capitalists, which is usually bigger companies, or angel funders. So these are the guys that gives the seed money for the company to grow. So seed money is the initial investment in a company, like planting a seed, and then the company grows from that money. So these are usually the people that own shares in a private company. Now, when a company decides to go public, it means that they give a part of their company, so for example 50% or 40%, they're willing to sell that amount to the public. So the public is any individual who chooses to buy the shares of that company, or it can also be, again, bigger investments or investing companies that buy shares. So when a company turns from private to public, they're giving parts of their shares. They're giving an initial public offering. So they go into the public and they say, here's the shares that we have. This is the value that we want per share. And now you can join our company. You can join the success of our company by owning a share. And the more successful the company is, obviously the stock price or the share price that you have will increase in its value. So for example, Apple stock or Samsung, or for example, when BP had the huge oil spill 8 years ago, to then invest in their stock because it dropped a lot due to PR and bad press. If you invested then, it would have definitely made a big return on your money. So it would have grown again once they kind of went over this hurricane of bad press and publicity. They would have stabilized. So if you bought then, the price would definitely go up. So that is what is an initial public offering.